Good morning, everyone, and thank you for joining us today. My name is David Aubuchon, Director of Quant and Feeds here in the Americas. Before we begin our webinar today, I'd like to cover a few housekeeping items. First, some technical notes. You can click on the media player on your screen to enable both the sound and the video. And if the video gets stuck, the best course of action will be just to refresh your browser. You can expand your slide window by clicking the maximize icon on the top right of your window, or by dragging the bottom right corner of the media player to make the screen larger. We will be taking Q&A at the end of today's call, so if you want to submit any of your questions in the Q&A box, please do so. And finally, the link to the recording webcast will be emailed to you after the conclusion of the event. And you should also be able to access free trial by clicking on the links on the top left-hand banner for any of the content that you see presented today. With the formalities out of the way, we can move on to the main bulk of the content of our presentation. Obviously, the title of today's presentation being How to Forecast Market Trends with Job Postings will place a large focus on the latter half of our presentation, where Adam Barron, who is part of our StarMine quant research team based here in San Francisco with me, to go over good ways to incorporate and visualize the LinkUp jobs posting data that we have available through our Quantitative Analytics Direct platform. But there's a few things that might be worth looking at in advance of that to think about other content sets that we think marry well or can be looked at in conjunction with job posting data to give you a good holistic picture. And snow in Texas or rallies and GameStop notwithstanding, much of the focus in the markets over the last year has been on the impact of COVID throughout the economy, which I think sets up the stage well to look at potential implications of job postings data on the segments that have been hardest hit. A series of industries clearly not escaping the limelight in 2020 and likely for much of 2021 will be the retail, hospitality, and restaurant industries. Even as we see restrictions being eased across the country, most agree that there won't be a rush of activity back to pre-pandemic levels in the near term. And at Refinitiv, we thought it would be useful to explore some of the ways that the struggles observed in these corners of the economy show up in data. And in particular, we'll be looking at, as I mentioned, kind of alternative data sets, i.e. LinkUp jobs posting data, as well as some of the, what you might consider more traditional financial content. And that's usually a good place to start is kind of where we are today. And we look at, for example, in our quarterly consumer spending forecasts, we typically look at IBIS earnings data. In this case, we'll be looking at about 50% reported results through Q4 of 2020. You'll note that overall, as of the 8th, when we published our consumer spending forecasts, the U.S. retail and restaurants earning index is supposed to decline in aggregate about negative 12%. When you look at the subcomponents, the one that will jump out there obviously will be the extreme decline in the hotel, restaurants, and leisure category, with the weakest anticipated Q4 sales estimates of almost negative 120%. Some bright spots, on the other hand, looking at household durables and leisure products, which have the highest earnings growth rates of almost 57 and 42.5% respectively. And we are seeing in the most recent earnings releases some signs, and certainly in price movement, things starting to tick back to normal. For example, on the 15th of this week, Nevada casino and floor restaurant capacity increased to 35% from 25%, with management at firms like Mgm expecting a return to 90% of 2019 levels by the end of next year. But as noted, it's going to take some time before we get from here to there. So we're expecting continued impacts to this particularly hard-hit sector of the economy for the medium to long term, because even as restrictions get lifted, obviously that doesn't mean everybody goes back to restaurants, hotels, and casinos as they did before. When we think about the hotels, casinos, and the sector posting weaker earnings last year, there's also other, hotels, cruise lines, and such that are also being impacted that fall into some of these categories. And there's other content sets beyond estimates that we think are likely interesting to look at as well. When we take a look at, as I mentioned, the earnings season to date, we've got about 50%, as you'll notice, in the hotel and entertainment sector here that have reported even in the wave of downward revisions quite dramatically over the course of the last quarter or so. It's interesting to note that still companies are missing revenue reports by almost 50%, which is not typically common of reporting as we look through earnings seasons, where analysts tend to do a pretty good job of revising pretty conservatively in the face of impacts like we're seeing with COVID. So sectors of the economy that are still missing and companies that are still missing reporting to the downside of that is not particularly typical, and is almost exclusively confined to this one hotels and entertainment services sector, which we think provides a good backdrop for the way we'll be presenting the LinkUp jobs posting data a little bit further on. And if your portfolio over the course of the last year hasn't been exclusively focused on Tesla, Moderna, and Bitcoin, you likely have some interest or exposure to those parts of the economy that have been slower to respond. When we look at the employment backdrop, particularly in the service sectors, the chart to the right, might be instructive in the sense that what we're looking at is the U.S. employment during and after the recessions over modern times since the 50s. And you'll see in this dark green line here the current employment figures as it relates to the impact of 2020, which we've just crossed the trough of where we were in 2007 with the depths of that recession and the unemployment figures produced as a result. And so, again, providing a backdrop of how employment is going to impact both consumption by individuals, but also as a leading indicator of potential return to normalcy for certain companies in sectors of hotel, restaurants, gaming, is going to be interesting to track both just from a macro perspective, but also down to an individual company basis when you look at how analysts are reacting to that, as well as the markets in terms of a trading environment. Interesting to note when we look at estimates in particular, right? When you look at companies like Boyd Gaming or Royal Caribbean or Penn Gaming or Mgm, things like that, you'll notice in about March is when you really saw analysts really significantly revise downwards, and you'll see quite dramatically kind of in the bottom rung here in terms of the high and low estimates being produced, their expectations for, obviously earnings, but also revenue growth downwards substantially. That has been upticked throughout the course of the year, right? So at the lows in March and then beginning to see some upside starting in June and July. But in no uncertain terms, the overall consensus has been down. And then when we look at the overall predicted surprise measures, have been tightening up as we're getting closer and closer to release. But about a week ago, almost across the board in every single company in these sectors, you would see a pretty large disparity between what we would consider our predicted surprise measure for StarMine and the actual consensus. And just as a reminder for those who are not as familiar, we obviously track in real time estimates and provide a kind of a weighting for every analyst based on their efficacy and their historical track record of predicting things like revenues, earnings, EBITDA, what have you. And when we notice there's a divergence between what we consider the smart estimate and the consensus mean of greater than 2%, what we find is that companies are likely to predict to the side of the smart estimate over 70% of the cases. So it's interesting to track the predicted surprise, particularly the further away that you get from earnings date, as it'll tend to foreshadow changes in analyst revisions towards the direction of the smart estimate, particularly if the predicted surprise is larger than 2%. And then obviously as earnings days get closer, those predicted surprise numbers tend to tighten. So this chart is almost, you can rinse and repeat over every single company that you'll notice in this sector, so not necessarily worth going through for 4 or 5 different companies. But it's definitely emblematic of, I think, the trend that you see overall in the space, which is to say a pretty big drop-off in expectations as we got through the first quarter of 2020, with improvements in expectations going forward as the year progressed. Moving away from StarMine estimates, another interesting content set to really take a look at is the impacts that it's had on credit ratings for the organizations impacted in the sector. We at Refinitiv have a host of content around credit analytics within our Starman franchise that we consider pretty indicative of changes in credit quality as well as predicted defaults that might be interesting to follow as well in conjunction with many of the job postings data that we'll look at later. So we have a concept of what we call a combined credit risk model, which is basically taking the concepts of credit risk across a few different vectors, a structural model whereby we're measuring the value of a company's assets and modeling as if it were an option in a modified Merton model. A smart ratios model, which kind of takes the traditional credit analysis and ratios underpinning that in profitability, leverage, coverage, liquidity, and growth ratios and kind of front loads it with IBIS estimates so you get a predictive view of those measures over time. And then lastly, a text mining model that will imagine if you were reading all the world's transcripts, Reuters news, filings, and research for allusions to changes, positive or negative, in allusions to credit quality, then combining those into what we would consider an overall combined credit risk gauge, providing an implied weighting as well as a probability of default score. And so as you would flip through a couple of different companies here, you'll notice a combined credit rating score that will change. These are decile ranked relative to their peers, both in an industry or in a region. In this case, you'll notice, for example, Royal Caribbean showing a single number one rank here out of a 1 in 100 decile ranking, in which they are near the bottom of the list as far as the most risky companies that we score here across the global universe of assets that we're measuring. And that's relative to, say, an S&P that currently has them rated a B+, though on a negative watch that they updated earlier in 2020. So oftentimes screening, and when you think about if you were to be looking at, like just before this call, there were 74 companies that scored in the bottom decile in the Russell 1000. As you might expect, about 15% to 20% sat in this hotels and entertainment services industries, which is just a confirmation of the bad time they've been having, obviously, but also the real impacts that they might have in terms of capital raising and or the longevity of their businesses, depending on how long it takes to get to the return to normalcy. The last little bit of content we thought would be interesting to show just in conjunction with some of the stuff we'll look at in the jobs posting data is more of like the social aspect of this, so meaning the sentiment analysis wrapped around news and social media. And if you were to look at, for example, this orange line here being the hotels and entertainment services industry as proxied by an ETF, you'll notice obviously the impact of that group of companies dropping dramatically really here towards the end of February of 2020. Whereas you'll notice actually the optimism associated with that by reading news and social media and producing an optimism sentiment score through our Market Psych brand of sentiment analytics started dropping actually pretty dramatically towards the end of December, early January, pretty far in advance of the actual price decline as witnessed by the constituents of that index. And then this purple line actually is a read of the mentions and the sentiment associated with layoffs in that same industry. So you'll notice about the same time as the optimism of that set of constituents for the ETF started dropping dramatically, you also noticed a pretty healthy spike in the mentions in social media news around layoffs as well, and the impacts that they would have for the companies in that ETF. And you'll notice that, for example, the optimism starts to improve along with, obviously, the price and the trading activity in the constituents of that index. And the layoffs have sort of died down here towards the end of the year, as most of that has sort of been talked about and or not mentioned nearly in as high volume as it was throughout the course of 2020, and certainly the latter half of that. So there's an awful lot of ways that you can kind of look to digest what has happened through the course of 2020 and probably into 2021 as we continue. But we thought it would be a good way to set the table really for Adam to think about and talk us through really one of the newer data assets that we have within our quantitative database set that we are presenting today, which is our LinkUp jobs postings data. I'll have Adam jump on now. That was about my 15 minutes of fame to kind of walk us through some of the best practices and the analytics that he's drilling up as it relates to companies in the context that we've talked about just now, And then certainly as we go on, if there's any questions, I'll be paying attention to the Q&A and can hopefully try to answer as many of those as we can get to at the end of this call. So with that being said, Adam, I will hand it over to you and stop my screen sharing for you.
Great. Thank you so much, Dave. That was a really good overview of the many different content sets we have here at Refinitiv and the ways to slice and dice it through ICON. Now we're going to get into a much more technical side of the presentation. Like, you're going to be seeing some Python code and data, so get ready for that. So what you're seeing right here is a Python notebook hosted on Jupyter. Just so you know, if you go to developers.refinitiv.com, all of the code is here too under articles. It's actually the second most recent article. It's slightly the companies in here are slightly different because this was posted a little bit before the webinar, but it's still essentially the same code. And if this is the article form, and if you want the actual code, you go under source code, and here's the Git repository for Refinitiv, and you can download the actual Python notebook file. So you don't need to be feverishly taking notes because it's there for you later. So anyway, so I'm going to be talking about the LinkUp content set, a new content set in our Refinitiv Quantitative Analytics database, previously known as QA Direct, for those of you who have been using it for a while. And I'm going to show basically how to access the data, what the data looks like, talk a little bit about it, then pull in some other data sets, show how there might be an interesting relationship between job postings and analyst revisions, then get into some research we did at StarMine about how to really quantify this into a signal that you might want to follow if you get tired of looking at charts. So into the code, the very first thing I always do with Python is bring in the libraries that I like, and I'm a huge fan of SQL Alchemy. In my experience, it's one of the best libraries to be connecting to relational databases, whether it's MySQL or SQL Server, which Refinitiv Quantitative Analytics is on. The way to connect is very similar across different types. You don't need to be installing weird drivers. It's just easy to use. And you can get the data back in pandas. And for those of you that don't know, pandas is not just a cute little bear. It's actually a very helpful library in Python that lets you deal with data in data frames, which are kind of like tabular formats, so it's easy to manipulate. And this is one little trick I always do with pandas, setting the max columns to 0, which basically tells them not to truncate columns, because when you pull from a database table and there are a lot of columns, the default setting might make some of the columns disappear, and you don't want that. So the very first thing we're going to do is to connect to that Refinitiv Quantitative Analytics instance. And this one is actually in the cloud, hosted on Azure. That's a newer offering in the quantitative analytics space, whereas our previous ones were mostly on-prem. And LinkUp itself is only available in the cloud-hosted version, so it's a good motivation to check out the cloud. And like any database connection, there's the server, the port, the database within it you're connecting to, username, password. Obviously, I'm not sharing my password here with everyone, all 100 of you on the webinar. And this is a trial server, so there's definitely ways for all of you to get access to the server. The exact server may be slightly different in your case, but the way to connect will be the same. Like I said, the connection string for SQL Alchemy is pretty straightforward with all those components. One thing to note is that when you're using on-premises databases, encryption is not really that important because you're just using your internal company network. Really no big security concerns. But when going over the public internet to the Azure hosted instance, you need to be concerned about encryption. So this encryption equals yes is very key, and if you don't use it, the connection actually won't work, and you'll get some mysterious errors that might seem mysterious if you're not familiar with it. So anyway, you make the connection. And then we got to decide what to look at. So my personal style when working in Python notebooks is to create a cell that kind of has all the parameters I want to use set to variables. This is a lot. This technique is a lot easier than, if I want to change up what company I'm looking at or change some time frame, I don't have to go hunting through tons and tons of Python code cells to figure out where did I set it. I know that the way I do things is I set all the parameter variables at the very beginning, and then I don't touch them later on. So it's just my own technique. And we're going to be looking at void gaming, which Dave was showing a bit in some of his examples. So for those of you that don't know, we have this site called permid.org. Permid is an open identifier, meaning you don't have to pay for it, unlike some of the proprietary identifiers. And we use it to not just identify companies. We also have, if we were to go down to the instrument and RIC level, we also have them for instruments and quotes. And we have, we even have it stuff, perm-IDs even for peoples on the officers and directors. So there's perm-IDs for a lot of things. It's all open. There's this website as well as APIs, etc. So anyway, this is, we're going to be looking at void, and we're going to be, across the content sets I'm looking at, we're going to be using the perm-ID at the company level to be pulling up data. So that's where this comes from. We're going to be looking at annualized financial data and for reporting at the end of 2020. And for most of you who are in this field, you know that just because the year end is, December 31st, 2020, reporting of the actual numbers usually happens a month and a half later around this time. We're going to be focusing on revenue. And these two things are just to help me on the plot. So it's very possible that analysts may be making predictions for revenue well before 2020 began, for the end of 2020, but we're only going to be focusing on the time period of 2020 till till about recently. And same with LinkUp. LinkUp has much deeper history too, but when we're charting these things, we're only going to be looking at the last year plus month and a half. And then this variable I'll get to a little bit later. This goes into that StarMine metric that we designed when we were looking at this about how to break this into a signal, and I'm just looking at a 30-day window, but more on that later. So the very first step is going to be to go from the perm-ID to the internal identifier that LinkUp uses. So, generally, all of our data sets usually have their own identifier within them, and perm-ID is how we link across. And as we invite more third-party alternative data vendors into our ecosystem, we're asking them to use perm-ID as well, so you can easily interop. And even some folks who aren't even on our data platforms are also using perm-ID, so there's good interoperability there. So anyway, there's a table which has the mapping of perm-ID to LinkUp's company ID, and it's point in time, so we need to be careful about dates. So I'm going to be focusing on the identifier for the date that we're interested in. And then it's just, really sending that SQL through SQL Alchemy to the database in the cloud and getting back the results, and we see that and here's the company ID for Void Gaming. So then next is grabbing the LinkUp data. So now that we have the company identifier, it's pretty easy. We're going to grab the full time series of jobs for Void Gaming, though later on we're only going to be using the most recent history. And it's pretty simple here. It's just passing in, going against the table. It has all the data, passing in the identifier and doing the same thing to get it out. And just one little hack here. In pandas, I'm strongly typing the date to a date type because it'll make it easier when plotting and doing other calculations. So this is what the data looks like. It's a very straightforward time series. You have the company identifier, you have the date. This is daily data. And what we're most concerned about for our analysis is this unique active job count. So LinkUp pulls basically monitors the company's own job posting sites. So we're not looking at third parties like Indeed or Monster. This is purely what the company is posting themselves. And the unique job count is the daily time series of, if you went to their website today, this is how many open positions they would have. We found that pretty useful in our research. There's other ways to look at this too. There's a created job count and deleted job count. So, you might, on this day, there might be a net change of -2, but in reality, it's because 21 were removed and 19 were created. So you might, if you care about those types of nuances, that's there too. And then active duration is a convenience calculation that can show you of all the jobs that are active, how long on average have they been up on the website. And it's worth noting there's some other tables too, particularly there's a table that gets into each job and its date for being posted and removed. And we're not going to be, for this research, we're not going to get into that. But that would give you details about the ONET code of the job posting, like, is it a data engineer, is it a security officer, the title, and some other metadata. So if you really want to get into the nitty-gritty details of each job a company is posting, maybe do analysis on like blue-collar jobs versus white-collar jobs, that's available to you. That is in another table, but that's not what we did in our analysis right now, looking at analyst revisions. So then, the other data we're going to get from quantitative analytics in the cloud is the estimates that Dave mentioned that the analysts are making. So we have a lot of estimates data. As Dave showed, there is data on the individual sell-side analyst level at the banks making these estimates and what they think, but we're going to be pulling the consensus, the equal weighted average, from this table. But before we do that, we need to get the identifier. So once again, passing in the organization firm ID, we're going to grab the estimate ID on a point-in-time basis, and this is what it is. And then, similarly, we're going to be pulling that consensus estimate. So the main SQL here is just what I've highlighted. It's very simple. So this table, the summary table, has that equal weighted consensus that we're interested in. And it's pretty simple as pulling in, the estimate ID, which uniquely identifies the company we're looking at, the revenue measure, the period end date, because, there's multiple years. People are not only are they making estimates for into 2020, they're making estimates for into 2021, 2022, et cetera. And the period type, we're looking at annual, but there is quarterly as well. So that's the main stuff. But all this other stuff, this other bit of SQL, which you might want to look at in more detail later from the code that I have referenced from the Refinitiv developer community, this is to actually dumb down the data. So we, as you saw, LinkUp has a daily time series, but the estimate is intraday. That means whenever an analyst revises her estimate, say at 9 a.m., then there's a new entry. Then at 11 a.m., if someone else revises his estimates, then there's a new entry there. So what this does is dailyize it by taking the last estimate in a given day with some fancy SQL, kind of fancy SQL, so that we just have one estimate on a day. It's going to make it a lot easier to plot the two and do calculations across the two. So, I've dumbed down the data. It's a lot more robust than what's there. But for the purpose of this, we want it in a daily time series. And this is what the data looks like. Here is me dailyizing the date. But know that for effective date, we have down to the minute changes. And a lot of columns here. The one we're going to focus on is the mean estimate. And then Dave was also mentioning smart estimates, which, coming from StarMine, I'm a big fan of. I mean, the star in StarMine came from giving those star ratings to analysts. 5 stars for an analyst that is much better than her peers for predicting those things like revenue, and 1 star for analysts that aren't that great. And it's in a very similar format because instead of an equal weighted consensus, it's just weighted based, giving more weight to the better analyst. So it's always, kind of a leading, following, letting you see what the leaders are thinking. So same things you pass in, but slightly different table. And I'm also, similarly, it's also intraday, so I'm dailyizing it. And the data looks like such, almost very, very similar to the consensus in that this is my as of date that I created, the effective date down to the minutes as analysts change their estimates. And we're going to be focusing on the SMART estimate. And just so you know, Dave mentioned this a little earlier too, predicted surprise is really what's important for those users of SMART estimates, because it's the difference between the consensus and the SMART estimate, meaning it's how much more bullish or bearish the lead analysts are compared to the herd. And this is the numerical quantification of that. We're not going to be using this in the analysis, but it's good to know that when you look at SMART estimates in the IBES content set, predicted surprise is really what's worth paying attention to. So next, we've got to put it all together. Like I mentioned, we're going to be looking at, this data can go far back, but we're only going to be looking at the beginning of 2020 till about now. So those are the putting it in date format, and then basically filtering 3 content sets down to those date ranges. And now for some plotting. So in Python, plotting can be simple or it can get a little complex. And I kind of wanted to get a lot in this chart. So, whenever you want to plot more than one thing in Python, after you do a plot command, you can get back the axis reference. As I'm first plotting the IBES consensus. So then when I plot the SMART estimate next to it, I'm referencing the axis, so it knows, plot on the same axis as that, and so forth. And then LinkUp, I can do the same thing, but as you probably understand, an estimate for a revenue number is going to be quite different from number of jobs. So we can't use the same y-axis. So that's why it's useful to do secondary y equals true, so it goes on another axis. So this is what the chart looks like. Yellow is that active jobs from LinkUp. Purple is the consensus estimate from IBES. I call it mean because it's what it is. It's an equal weighted average. And then orange is a SMART estimate. And you'll see on the left-hand axis is the revenue numbers, and on a different scale on the right are the active job postings. So Boyd Gaming is actually a really compelling example about why you want to pay attention to active jobs. It's no surprise in March, they were pulling back jobs, and only after a little bit of lag did the sell-side analysts start revising their estimates down. And just so you know, the SMART estimates were slightly ahead. The SMART estimates in orange were slightly ahead of the consensus estimates in purple until they eventually converged. Now, in our experience with the way our intuition around active jobs postings was that, companies change their job postings either in reaction to something that happened or in anticipation of how they think the future will be. And this does vary from company to company. So, in this, and similarly, analysts, those folks at the top banks, their job is to, pay attention to the companies, look at the news about these companies, look at the financials they may release in their filings, join their earnings calls, ask hard questions. So whatever public information is out there, they're incorporating into their estimates and they're revising accordingly. So when you see a gap like this, it probably indicates the situation where Boyd is anticipating something that is not yet known to the analyst, where sometimes these move in tandem, and sometimes the analyst might actually revise before the job posting. So it's not always the case that job postings proceed, but when it is the case, it's very interesting. That's to pay attention to. And just so you know, another interesting thing happened coming into July when Boyd had 0 job postings. They gradually brought it up to 400, and analysts were coming in lockstep along the way. So these are not all companies have this pattern where there's significant job movement and analysts have not yet moved, but those that do are worth paying attention to, and that leads us into the next, the next bit of code. So at StarMine, we wanted to looking at charts is cool and all, but it gets a little tiresome, and that's really not how quants work. So we wanted to create a metric that would basically, a signal that would basically indicate when we should pay more attention to one of these companies. And that's what we call analyst awareness. Are the analysts aware of whatever is motivating the company to change their job postings? Sometimes that could be reaction to public events or, like I said, anticipation of future events. So, and it's basically the overall formula is looking at the percent change over a time period of the job postings versus the percent change over a time period of the analyst revisions, percentage form, because they're different metrics, and then looking at the difference of the two. So that when it deviates significantly from 0, that's when you should pay attention. So this code is a little complex, but like I said, it's something in your own time you might want to deep dive into further, but I'll briefly go over it. So like I hinted at earlier, I set the look back days to 30 as that window. In all honesty, our research priority shifted, so we didn't get to go too much beyond initial, this point. In our initial analysis, 30 days seemed right because it was somewhat recent, but it wasn't, it was somewhat recent. If you do too much of a lag, like 90 days, it's not fast moving. And too short, it might be a little jumpy. So that seemed right, but we didn't have really with our priority shifting, we didn't have the time to find the optimal day range, nor did we have the time to enhance this formula even more. But that's why this is a parameter, so when you go through the code, you can change it accordingly. And it's a starting point. This is where our research kind of ended, but your research could continue there if you really wanted to. That's the point of sharing this. So first thing we've got to do is, with the LinkUp data, find what the date was 30 days ago, so it's a simple time delta calculation. Then you do a self-join, or self-merge, as they call it, in pandas on LinkUp, so you have both the present date and the past date 30 days ago. And then it's just a simple change calculation. It's just the present minus the past divided by the past to get the trailing job change. Now, doing it for the estimates is a little bit more challenging. So as I was mentioning earlier, with IBES, we have changes in, as the analyst makes her revision, there will be a new entry in the database. But if no analyst made a revision for 5 days, there's no entry. It's just purely based on the events of analyst changes. However, LinkUp is daily, and if we want to do a comparison between, the two, we need to essentially create daily, make it each day have a value. So that's what this Python date range does. We start with the first date that IBES has data for, going to the last date we're plotting and and basically doing a daily frequency. So that will give us a pandas data frame of all the dates. And then this fill forward function is what basically, if there is no estimate on a given day, take the most recent estimate. And in reality, that's how this works. If an analyst doesn't change his estimates, he's saying that, I still stand by this number. So if there's no revision, it's the other estimate stands. So that's what this is doing. Then we can do the same stuff of finding the past date for the, 30 days ago, doing the self-join again to get the past and present estimate numbers, doing this percentage change of present minus past divided by past. And then gets the interesting stuff. We join the two data sets together for analyst awareness, and that's just, of the percentages, that's just the difference of the two. And then we do some plotting. So, it kind of looks like this. We want to focus our eyes around 0 on the y-axis for the analyst awareness. And whenever there's a strong deviation from 0, that's when you need to pay attention. So you'll see there's a strong deviation in March going down, and then a strong one jumping up in July, which relates to, this chart here. March is when the analysts, was when the jobs were being removed before the analysts revised, and similarly, in July as well, it was steadily increasing, and the analysts were, kind of catching up there. And you'll notice as they catch up, or as time passes past the 30-day window, it kind of flattens to 0. So that was our way of trying to put it into a signal. It could probably be refined further, but this is where we got to in the time we had. So then, putting it all together for convenience purposes, I created this function that has all of it chained together, so you can look at other companies more easily without rerunning all those cells. And Dave was showing Royal Caribbean, and this too is, we're still looking at revenue here. And once again, it had that really big drop in March, but it didn't, and then analysts followed, purple again being the consensus. And once again, smart estimates, the lead analysts were actually pretty, the lead analysts for this, as represented by the orange smart estimate, kind of show that they were, ahead of the active jobs. But they came after the active jobs, not too far active. It took a while for the herd, the consensus, to catch up. And they eventually converged at this point. And what's interesting is that, for the most part, the analysts kept revising down, and it took a while for Royal Caribbean in July to just drop their jobs even more. And now it's been kind of down for everyone, not much activity as of late. And then the final example that I'll go through here is Mgm Resorts, which Dave also talked about. It too has that same pattern of March jobs were dropping. The purple consensus estimate eventually followed, smart estimate being faster, but still the jobs being pulled before the analysts changed. And what's most, and like we saw earlier with Boyd Gaming, there was an uptick in July that's been steadily increasing. But, in this case, the analysts have not revised up. In fact, they're getting more bearish. And this is really, this is the point that if you were a fundamental or quantamental analyst, you'd want to start thinking more about this, like why is this happening? And you'd want to, you want to spend time asking the question, why does MGM Resorts think things are looking up, but the analysts are still bearish on this? And, as investment professionals, you probably have many ways to do that. The quants on the call, well, you have the luxury of having many different content sets. One thing with alternative data is that it's not a silver bullet. It's very rare that an alternative data set alone is going to tell you how to invest. As we saw, an alternative data set alongside another data set like revisions, analyst estimates, is helpful, but that's when you think, well, maybe you need to combine this with other data sets you have, other data sets Refinitiv has, or other trading strategies you have. When adding on, it could give you that extra juice, and perhaps those other content sets could help you figure out what's going on here with this difference of opinion between the company and the analyst. And here's more of the signal, that analyst awareness quantified into a single signal. So anyway, that's what I wanted to get through. Hopefully, hopefully your mind's not too bogged down with all this coding. And just as a reminder, we do have that code available for you to go through at your own pace. But hopefully this gave you a good concept of what we have in the Refinitiv Quantitative Analytics in the cloud with our new data set, LinkUp, from with our partner, LinkUp, for some third-party alternative data, and our existing IBES estimates and smart estimates that have been around for a while, and things you could do with it. So with that, I will stop sharing, and I think it's time for Q&A, which I believe Dave is going to lead the charge on.
Yep, thank you, and appreciate the presentation, Adam. Great job. There are a couple questions that have come through, so we'll start getting through those now. One quick question was just a request to repeat the name of the GitHub repo that you're using for the Jupyter example in QAC.
Oh, okay. It's github.com refinitiv-api-samples. But the easier way to get to it is to go to developers.refinitiv.com and navigate to this article, the forecasting with the LinkUp. So But once again, it's github.com refinitiv-api-samples.
Perfect, thank you. Second question in was asking how much history is observed is available via the LinkUp dataset.
Oh, it's been a while since I looked at this, but I want to say that there was a good amount of coverage around 2007, 2008, but there could be deeper history for different companies. So, with many alternative data sets, it's this question of when is the first data point versus when is there good momentum. And from what I recall, it's been a while since I did the deep historical analysis. I think it's 2007, 2008, where there's a really good amount of data.
Perfect, thank you. Another question came in, maybe it's tangential to what we were talking about earlier, but asking the question if there are other content sets that you would analyze alongside LinkUp that you find would be interesting.
Yeah, so we have something called significant events, which is also in quantitative analytics. Basically, it's driven from the news, but actually humans over the years have been tagging events like new product launches and layoffs. So one idea that we were exploring a bit was to see if behavior in job postings could precede layoffs. We did some analysis. Some was promising, but once again, research priorities changed. But extending upon that, other stuff we've done at StarMine is text mining. For instance, Dave mentioned our text mining credit risk model from back in 2011 that used bag of words, naive Bayes kind of approach to predict probability of default, the default event. More recently, we've actually been using BERT, which is a variant of TensorFlow, to predict events such as mergers and acquisitions, secondary offerings, divestitures. The M&A targets, is actually hopefully coming out later this year. So our thought was to look at the news and try to learn what language may foreshadow company layoffs, and in conjunction with LinkUp to see what behavior patterns in postings may also lead up to layoffs, and then have a combined, signal there. We never actually had the chance to get around to that, but we only explored that a little. But that's if we were to look more at that, I think significant events in conjunction with news, in conjunction with LinkUp to predict layoffs would be a very interesting project.
Great, thank you. There's a question submitted by Robert, which maybe not super specific to which content set he's referring to, but maybe I compare it with another one that came in. Robert asking if there's any new fields or attributes. I'm not sure if that was specific to LinkUp data or some of the other content that was listed here. But in conjunction with another one that had asked about other data sets to use within the hospitality industry. Going back to when we were talking about the estimates database, the IBIS estimates database, we've obviously spent a lot of time talking about the overall kind of the headline metrics like consensus mean for EPS or revenue or what have you. Important to note that we do collect a litany of what we call KPIs, or key performance indicators, that are very industry-based. So you would get things like occupancy rates, out of the hotel sector, you would get segments. So for companies that are producing content or analysts that are submitting estimates, say splitting up, say Las Vegas versus Macau or otherwise, we will be capturing the level of granularity as produced by the analysts for the estimates for a given sector. So there's a deeper level of content than just the headline ones we were talking about. But those can also be incorporated in here as well. So, for example, if you maybe wanted to think about pairing like occupancy with job postings or something like that, might be interesting to look at. But as it relates to any quote-unquote new fields or attributes, stuff that we're producing all the time, I guess it kind of depends on the content set in particular that we're talking about. One last question that looks like that we have, maybe more of a technical-oriented question, Adam, was asking whether you always use code notebooks for your research, or if there's any other tools that you might be using.
Yeah, so I'll geek out a little here. Yeah, mostly we do, what you saw was a notebook that I just ran on my laptop running Jupyter there. But a lot of the work we do at StarMine is on much bigger data than this example. As I mentioned, we've done a lot with text mining, and when we have hundreds of gigabytes of just news alone, plus the other text data, we can't do that on a laptop. So we tend to use the cloud services. My experience, we've used a lot of AWS, but we also use some GCP, Google Cloud Platform. So when we're using those, we use notebooks. So if we're on AWS, it's like the SageMaker notebooks that does our same analysis, but instead of querying a database, we may be pulling from S3 or maybe running an Athena query to do aggregations and then pulling that data into our analysis. And also using it to launch the actual SageMaker distributed machine learning. In GCP, the Colab notebooks are helpful, especially if we're doing something with TPUs, the tensor processing units. So, as a general principle, the way research is, it's, we like the reproducibility, the auditability of having the notebooks with good documentations to follow our flow. However, when we hand this off, when we are confident with the model and we hand it off to the production team, the engineers bring it to production, they're not using notebooks. They're using actual code. So yeah, the notebooks are heavily used by the researchers, but it kind of stops there as the things that come to production are more hardcore coding.
Great, thanks for that, Adam. Well, that wraps it up for today. Again, appreciate everybody's time joining. We invite you to request any complimentary trials of any of the content that you've noted, including LinkUp data via the links available on your screen. And then lastly, please leave your feedback in the survey once the webinar is over to suggest anything that you would like to see more of, less of, or how you enjoyed today's webinar. Thanks to Adam for contributing the LinkUp research views today, and from everybody here at Refinitiv. Hope you guys have a wonderful rest of your week and look forward to catching up soon.